Will prices finally drop in 2026? It's the question on everyone's mind. For 2 years, we've been hearing whispers of a coming economic winter, a crash back to reality. The question for every investor isn't if a correction is coming anymore, but when. And all eyes are on 2026 as the potential year of reckoning. The common wisdom is that when the tide goes out, every ship sinks with it. But while most people are paralyzed by the fear of a universal price drop, they're missing the massive shifts happening just beneath the surface. There are two incredibly powerful forces at play that will make a 2026 price drop for gold next to impossible. And the mainstream media isn't talking about them. Today we're revealing why gold is set to defy any downturn thanks to unstoppable trends rewriting the old rules. This isn't speculation. This is about a structural demand so huge, it's creating a new reality for the world's oldest form of money. The first, and maybe the most powerful, force making gold immune to a 2026 price drop is the historic buying spree by the world's central banks. This isn't a small trend. It's a fundamental shift in the global money game. Just for context, since 2022, central banks have been adding over 1,000 tons of gold to their reserves every single year. That is a massive acceleration from the 600-ton average they were buying in the decade before. Pause on that for a second. The very institutions that manage the world's currencies are aggressively moving out of those currencies and into physical gold. This isn't a panic buy, it's a deliberate long-term strategy. Goldman Sachs expects this to continue, projecting that central banks will keep buying gold. JP Morgan is even more optimistic, expecting them to snap up about 190 tons every quarter. Through the first 9 months of 2025 alone, their purchases have already hit a massive 634 tons. So why are they doing this now and with such urgency? It all comes down to one word: de-dollarization. When Russia's dollar reserves were frozen in 2022, it sent a shockwave across the globe. It was a clear message to every other country: your US dollar holdings aren't just assets. They can be used as political leverage and shut off instantly. For developing nations, especially giants like China, that was a serious wake-up call. The risk of holding dollars became impossible to ignore. Gold, on the other hand, has no counterparty risk. It can't be frozen, sanctioned, or canceled by another government. It's a politically neutral, sovereign asset you can hold in your own vault. That's why the People's Bank of China has been buying hand over fist, and it's why a 2025 World Gold Council survey showed that central banks have the strongest intention to keep buying gold since the survey started in 2019. They aren't just hedging against inflation anymore. They're hedging against geopolitical risk and diversifying away from a world dominated by the US dollar. This demand from central banks is so large that major financial firms now consider it a structural price floor. Deutsche Bank estimates this buying has created a solid floor under gold. Any dip below that level is now seen as a buying opportunity, not just for regular investors, but for the most powerful financial players in the world. As one analyst put it, it's a beautiful cocktail that explains why gold's run is here to stay right through 2026. And this is happening quietly, before most investors even notice the shift. The second unstoppable force is the tidal wave of investment money flooding back into gold exchange-traded funds, or ETFs. If you're not familiar, a gold ETF is a fund that trades on a stock exchange like a share of Apple. But each share represents a piece of real physical gold held in a secure vault. For most people, buying an ETF share is the easiest way to invest in gold without the headache of storing and insuring it yourself. For a few years after the 2020 peak, investors were actually selling their ETF shares, which put downward pressure on gold's price. That trend has now slammed into reverse. Here's the one number that matters. The third quarter of 2025 saw a staggering 222 tons of gold added to global ETFs, the largest quarterly inflow in years. This tells us that the Western investor, who historically drives gold's biggest bull markets, is getting back in the game in a major way. So what's pulling all this money in? The main driver is the US Federal Reserve's shift in policy. In 2025, the Fed started cutting interest rates, and lower rates are like rocket fuel for gold. Think about it. When interest rates are high, holding gold has an opportunity cost because you could be earning a safe return from a government bond. But as interest rates fall, that cost disappears. Gold suddenly looks a lot more attractive than bonds, especially when inflation is still hanging around. Analysts expect this trend to pick up steam in 2026. JP Morgan predicts 275 tons of gold, will flow into ETFs annually in 2026. State Street, a huge ETF provider, notes that year-to-date inflows are already on a record-breaking pace, yet the total amount of gold held in ETFs is still below previous highs. Van Eck agrees, pointing out that since ETF holdings are well below their old peaks, there's a ton of room for more money to flow in as investors rebuild their positions. In North America alone, the assets in major gold ETFs have already jumped significantly in 2025. This isn't just a small group of investors, it's a massive shift of capital. As people search for a safe haven from market chaos and a hedge against their currency losing value, ETFs are the go-to tool. This new demand directly competes for the world's limited supply of physical gold, pushing prices higher. While central banks are building the price floor, this flood of ETF money is the powerful tide lifting the price to new heights. But this demand has a dangerous side effect most people don't see yet. The third and final force putting a jetpack on gold is the simple fact that our world remains deeply and persistently uncertain. Gold has always been the ultimate safe haven asset, the financial bedrock people turn to in a crisis. The difference today is that crisis and uncertainty are no longer just temporary events. They've become a permanent feature of the landscape. Just look at the world stage. We have ongoing trade tensions and the threat of new tariffs that spook investors and push them towards safety. The unresolved conflicts in places like Ukraine and the Middle East are constant reminders of how unstable the world is. These events don't disrupt gold mining directly, but they crank up the fear dial, and that sends capital running from assets that depend on global harmony and toward assets that are immune to it. Gold is the number one beneficiary of that flight to safety. That side effect is volatility. When flows reverse, they move fast. And it's not just geopolitics. There's a deep sense of economic anxiety. Global government debt has ballooned to a number that's 3 to 4 times the size of the entire global economy. In the US, massive government spending and ongoing deficits are putting long-term pressure on the dollar, which is historically a huge tailwind for gold. When people lose faith in the future buying power of the world's main currency, they turn to the one form of money that's held its value for 5,000 years. This mix of factors creates a powerful psychological driver for gold demand. It's what JP Morgan is talking about when they point to economic and geopolitical uncertainty as key reasons for their bullish outlook. It's what State Street Global Advisors sees when they say there's a 30% chance of a bull case pushing gold over $5,000 an ounce, triggered by market shocks or stagflation. It's a rare alignment of factors, as one analyst described it, creating intense upward pressure on the price. These are not short-term problems with easy fixes, which means they will continue to fuel demand for gold as a safe haven through 2026 and beyond. And this kind of uncertainty doesn't fade, it compounds. Now, to be fair, we have to acknowledge the counter-arguments. Some would say a major market crash could force investors to sell gold just to get cash. Others might argue that if the Fed doesn't cut interest rates as much as expected, the dollar could get stronger and create headwinds for gold. And these are valid theoretical risks. However, the overwhelming consensus from the world's top financial institutions is that these risks are tiny compared to the powerful bullish forces we've been talking about. A major price correction just seems highly unlikely. Now connect this to what's coming next. Don't take my word for it. Let's look at the numbers. What's fascinating isn't the numbers, it's how aligned they are. These are the 2026 price targets from the biggest names on Wall Street. Between JP Morgan, Goldman Sachs, and Bank of America, forecasts cluster right around the $5,000 per ounce mark for 2026. Morgan Stanley sees it hitting $4,500 per ounce by mid-year, and ING projects a $4,325 average. Then there's veteran analyst Ed Yardeni, who has an incredible track record with a stunning target of $6,000 per ounce for 2026, noting his previous targets were hit much sooner than he expected. We're talking about a powerful, unified consensus. The average forecast is clustered between $4,500 and $5,300 an ounce. And crucially, none of these predictions rely on some new disaster happening. They're based on the trends that are already in motion. The evidence is clear. The experts who live and breathe these markets don't see a price drop coming. They see the exact opposite. So what does all this mean for you? It means that while the headlines scream about a 2026 price drop, the real story is about a fundamental reset in the value of money itself. The evidence is already forcing institutions to act long before retail investors catch on. The unstoppable forces of central bank de-dollarization and a massive wave of investor capital are creating a powerful new bull market for gold. This isn't a speculative bubble. It's a logical reaction to a world dealing with record debt, nonstop turmoil, and a strategic move away from the dollar. For anyone looking to protect their wealth in an uncertain future, the market's message is getting louder and clearer every day. While other assets may fall, a rare alignment of powerful forces suggests that for gold, 2026 won't be a year of decline. It will be a year of defiance. Do you think gold breaks $5,000 before 2026? Or does it take a crisis? Drop your call below. And if you want to stay ahead of major financial shifts like this one, make sure you subscribe and hit the notification bell so you don't miss our next video. Thanks for watching.